I need to tell you something that goes against everything you think you know about me. While everyone is panicking, while the headlines are screaming about crashes and corrections and chaos, I am buying dividend stocks, not shorting, not hedging, buying, and I am buying 3 specific dividend stocks that most investors are too terrified to even look at right now. Now, I know my reputation. I am the guy who bet against the housing market in 2007. I am the guy who sees crashes before they happen. I am the contrarian who profits from disaster. So why would someone like me be buying dividend stocks during a panic? Because that is exactly when you should be buying them. Let me take you back to 2008. The financial system was collapsing, banks were failing. The S&P 500 had dropped over 50% from its highs. Every financial expert on television was predicting the end of capitalism as we knew it. And what was I doing? I was not buying the speculative garbage that had caused the crisis. I was buying real businesses with real cash flows that had been thrown out with the bathwater, companies that had nothing to do with subprime mortgages but had been crushed, because investors were selling everything in a panic. I remember looking at my screen in October of 2008. There were dividend stocks yielding 10, 12, even 15%. Not because the dividends were about to be cut, because the stock prices had been demolished by indiscriminate selling. Institutional investors were facing redemptions. Hedge funds were being forced to liquidate. Everyone was selling everything regardless of quality. That panic created the best buying opportunity of my lifetime. The stocks I bought during those dark days went on to generate returns of 300, 400, even 500% over the following years. And the dividends I collected along the way were extraordinary relative to my purchase prices. The lesson I learned was simple, but profound: panic creates opportunity. When everyone is selling, when fear dominates every decision, when investors abandon rational analysis and simply dump their holdings at any price, that is when fortunes are made. Not by joining the panic, by taking the other side of it. Today I am seeing something similar, not identical. The circumstances are always different, but similar enough that my pattern recognition is flashing bright green. Dividend stocks have been crushed. Valuations have collapsed. Yields have spiked to levels that historically signal major buying opportunities, and most investors are too scared to act. Before I tell you which 3 dividend stocks I am buying, let me give you my framework for evaluating dividend investments during periods of market stress. There are 4 criteria that must be met before I will commit capital first. The dividend must be sustainable. This sounds obvious, but most investors get it wrong. They chase high yields without analyzing whether the company can actually afford to pay. I look at payout ratios, free cash flow coverage, balance sheet strength, and the track record of dividend maintenance through previous recessions. A dividend that gets cut is worse than no dividend at all. Second, the business must have pricing power during economic stress. Companies without pricing power see their margins compressed. They cannot pass along cost increases to customers. Their profits shrink even if revenues hold steady. But companies with pricing power can raise prices and maintain margins. They emerge from recessions stronger than they entered. Third, the valuation must be compelling relative to historical norms. I am not interested in buying a stock just because it has fallen. I want to buy it because the current price represents a significant discount to intrinsic value. That discount provides a margin of safety. Even if I am partially wrong about my thesis, the valuation cushion protects me from permanent capital loss. Fourth, there must be a catalyst for value realization. Cheap stocks can stay cheap for a long time. I want to see something that will cause the market to recognize the value, whether that is insider buying, activist involvement, strategic alternatives, or simply the passage of time as dividends compound. With that framework in mind, let me tell you about the first stock I am buying. This is not my favorite of the 3, but it is extremely compelling and illustrates why panic creates opportunity. The first dividend stock I am buying is a major telecommunications company that has been absolutely demolished by the market. The stock is down over 60% from its highs. The yield has spiked to nearly 8%, and the narrative around this company is overwhelmingly negative. Here is what the bears say. They say the company has too much debt from past acquisitions. They say cord cutting is destroying the traditional media business. They say competition in wireless is intensifying. They say the dividend is at risk. And on the surface, these concerns sound reasonable. But let me tell you what I see when I look beneath the surface. I see a company generating over $20 billion in free cash flow annually. I see a dividend that consumes less than 60% of that free cash flow, leaving ample cushion for debt reduction and reinvestment. I see a wireless business with over 100 million subscribers that generates recurring revenue month after month. I see a fiber optic network that represents critical infrastructure for the digital economy. The market is treating this company like it is going bankrupt. But the numbers tell a completely different story at current prices. You are buying the free cash flow at less than 6 times. You are getting an 8% yield that is well covered, and you are getting exposure to essential communications infrastructure that society cannot function without. Let me share something that most investors overlook. This company has maintained or increased its dividend for nearly 40 consecutive years. Through recessions, through technological disruptions, through competitive pressures, through everything. The dividend has been sacrosanct. Management understands that their shareholder base depends on that income. They will cut almost anything else before they cut the dividend. The debt concerns are overblown. Yes, the company has a large debt load, but the debt is long dated. The interest payments are easily covered by cash flow, and the company is actively paying down debt while still funding the dividend and necessary capital investments. The balance sheet is improving, not deteriorating. As for the cord-cutting narrative, that is old news. Everyone knows traditional pay television is declining. The market has been pricing in that decline for years. What the market is not pricing in is the growth in wireless, the growth in fiber, the growth in business services. These segments are more than offsetting the pay television declines, but you would never know it from the stock price. I expect this stock to be 50 to 100% higher within 3 years as the market recognizes that the disaster scenario is not materializing. In the meantime, I am collecting an 8% yield on my investment. That is my kind of risk-reward. No, let me tell you about the second stock I am buying. This is my favorite of the 3, the one I have the highest conviction in, and the one I believe offers the greatest total return potential. The second dividend stock I am buying is a major pharmaceutical company that has been caught up in the panic selling despite having nothing wrong with its business. The stock is down over 40% from its highs. The yield is approaching 6%, and the company is trading at less than 8 times earnings. Why has this stock been crushed? Primarily because of patent cliff concerns. Some of the company's blockbuster drugs are losing patent protection over the next few years. Generic competition will erode revenues from those products. And the market has extrapolated that concern into a disaster scenario where the entire company becomes worthless. But here is what I see. I see a pipeline of new drugs that the market is completely ignoring. I see dozens of compounds in late-stage clinical trials. I see recent approvals that are ramping faster than expectations. I see a research and development engine that has consistently produced innovative therapies for decades. The patent cliff is real but manageable. The company has successfully navigated patent cliffs before. In the 2000s, it lost exclusivity on several major products, and people predicted its demise. Instead, new products filled the gap, and the company emerged stronger. The same playbook is being executed today. Let me give you some specific numbers. The drugs losing patent protection generate approximately $15 billion in annual revenue. The new products already approved and launching are projected to generate over $20 billion in peak revenue. The pipeline in late-stage trials has an additional $30 to $40 billion in potential revenue. The math is overwhelmingly favorable, but the stock price ignores it entirely. Meanwhile, the company is sitting on a fortress balance sheet, over $30 billion in cash, minimal debt relative to cash flow, the financial strength to make acquisitions, fund research, and maintain the dividend, regardless of short-term patent pressures. The dividend itself has been increased for over 60 consecutive years. 6 decades of annual increases through every economic environment imaginable. This is not a company that takes its dividend commitment lightly. The payout ratio is conservative, the coverage is abundant, the track record is impeccable. At current prices, you are buying this pharmaceutical giant for less than 8 times earnings. You are getting a 6% yield. You are getting a pipeline worth tens of billions that the market is assigning zero value. And you are getting a company that has navigated every challenge for over a century. I believe this stock doubles within 4 years. The pipeline will deliver, the new products will grow, the patent cliff concerns will fade, and the market will reward the company with a more appropriate valuation. In the meantime, I am collecting substantial dividends and sleeping well at night. The third dividend stock I am buying is perhaps the most contrarian of the three. It is a company in a sector that everyone has left for dead, a sector that has been in decline for years, a sector that most investors will not even consider. The third stock is a major tobacco company. I know what you are thinking. Tobacco is dying, cigarette volumes are declining, regulations are increasing. This is a melting ice cube. Why would anyone invest in tobacco? Let me tell you why. Because melting ice cubes can be extraordinarily profitable investments if you buy them at the right price. And right now, tobacco stocks are priced as if the industry will disappear overnight, which is not what the data shows. Yes, cigarette volumes in developed markets are declining at 2 to 3% per year. They have been declining for decades. This is not news. But here is what the market ignores. Tobacco companies have pricing power. They have been raising prices faster than volumes decline. Revenue has been stable or growing despite volume declines. Profits have been stable or growing, dividends have been stable or growing. This specific company yields over 9% at current prices. 9%, that is extraordinary for a company with stable cash flows and a 60-year track record of dividend payments. The payout ratio is around 70% of earnings, which is sustainable for a business with minimal capital requirements. But the story gets more interesting. This tobacco company has been investing heavily in reduced risk products, heated tobacco vapor products, nicotine pouches. These products are growing rapidly and carry higher margins than traditional cigarettes. The company is transforming itself from a pure cigarette manufacturer into a diversified nicotine company. The market assigns essentially zero value to these growth initiatives. The stock trades at less than 7 times earnings, which is pricing in permanent decline and eventual obsolescence. But if the reduced risk products succeed, and the early data suggests they are succeeding, the company has decades of profitable life ahead of it. Let me address the ethical concerns directly, because I know some investors avoid tobacco on moral grounds. I am not here to tell you what to invest in. That is your decision. But I will point out that tobacco is a legal product consumed by adults making informed choices. The companies are transparent about the risks, and the tax revenues generated fund substantial public services. From a pure investment perspective, tobacco has been one of the best performing sectors over the past century. The combination of pricing power, high margins, low capital requirements, and substantial dividends has generated extraordinary total returns. The current pessimism creates an opportunity to participate in those returns at valuations that provide significant margin of safety. I expect this tobacco stock to generate total returns of 15 to 20% annually over the next 5 years. The 9% dividend yield provides a substantial base return. Any multiple expansion or earnings growth is upside, and the downside is limited because the valuation already assumes a very negative scenario. Now let me synthesize what these 3 dividend stocks have in common and why I believe they represent exceptional value today. First, all 3 are deeply out of favor. Telecommunications is hated because of cord cutting and debt concerns. Pharmaceuticals are hated because of patent cliff. Fears tobacco is hated for obvious reasons. But out of favor is where you find value. Popular stocks are expensive. Hated stocks are cheap. Second, all 3 generate enormous free cash flow. These are not speculative companies hoping to someday turn a profit. They are cash machines that have been generating profits for decades. The cash flow provides the foundation for sustainable dividends and the flexibility to invest in future growth. Third, all three have long track records of dividend growth. These are not companies that started paying dividends last year. They are dividend aristocrats with multi-decade histories of maintaining and growing their payouts. That track record provides confidence that the dividends will continue forth. All three are trading at historically low valuations. The price-to-earnings ratios are near multi-decade lows. The dividend yields are near multi-decade highs. The gap between current valuations and historical norms creates substantial upside potential. Fifth, all three have catalysts for value realization. The telecommunications company has debt paydown and wireless growth. The pharmaceutical company has pipeline readouts and new product launches. The tobacco company has reduced risk product adoption and margin expansion. These are not value traps. They are undervalued businesses with clear paths to recognition. The common thread across all three investments is that the market has extrapolated current challenges into permanent decline. But that extrapolation ignores the adaptability of these businesses, the strength of their cash flows, and the conservatism of their balance sheets. The pessimism is overdone. Let me talk about how I think about portfolio construction when investing in dividend stocks during a panic. I am not putting all of my capital into these three positions. I am building positions systematically over time, averaging into the weakness rather than trying to call the exact bottom. I have allocated approximately 15% of my portfolio to these three dividend investments. Split roughly equally among them, that is enough to make a meaningful impact on my overall returns, but not so much that a further decline would cause unacceptable losses. I am also maintaining substantial cash reserves that I can deploy if prices fall further. Some of the best purchases I have ever made were on investments to existing positions when prices declined after my initial purchase. Having dry powder available is essential during periods of panic. For investors considering similar positions, I would suggest starting smaller than you think appropriate. Panic can persist longer than you expect. Prices can fall further than seems rational. By starting small and averaging in, you avoid the psychological pressure of being underwater immediately after establishing a position. I would also suggest focusing on the yield rather than the price. If you are buying dividend stocks for income, the yield at your purchase price is what matters. A lower price means a higher yield on your investment. Price declines should be welcomed, not feared, as long as the dividend remains secure. Let me share something about the psychology of investing during panic that has taken me decades to fully appreciate. The reason most investors fail to buy during panics is not that they lack the analytical skills to identify value. It is that they cannot overcome the emotional resistance to acting when everything feels dangerous. When prices are falling, when headlines are negative, when everyone around you is selling, every instinct tells you to sell too. This is a survival mechanism that served our ancestors well when fleeing from predators. But it works against us in financial markets. The investors who build wealth over time are the ones who can override those instincts. They can buy when their emotions scream sell. They can be greedy when others are fearful. They understand that the best opportunities arise precisely when things feel worst. I have trained myself over decades to recognize the feeling of fear and to interpret it as a potential buy signal rather than a sell signal. When I feel the urge to panic, I pause and ask whether the fundamentals have changed or only the prices. If only the prices have changed, that is often an opportunity rather than a threat. The three dividend stocks I have described today all triggered that fear response when I first looked at them. The telecommunications company with its debt load and cord-cutting pressures made me nervous. The pharmaceutical company with its patent cliffs made me worried. The tobacco company with its secular decline made me hesitant. But in each case, when I moved past the emotional response and analyzed the fundamentals, I found businesses that were far stronger than the market was pricing in. The fear was creating the opportunity. This brings me to my final point about why dividend investing during panics is so powerful. When you buy dividend stocks at depressed prices, you lock in high yields that persist for as long as you own the shares. Even if the market takes years to recognize the value, you are being paid handsomely to wait. Consider the pharmaceutical stock I described. At a 6% yield, I am earning 6 cents per year for every dollar I invest. If I hold that position for 5 years and the dividend grows modestly, I will have collected over 30% of my initial investment in dividends alone. The stock price could go nowhere and I would still earn a reasonable return. But of course, the stock price is unlikely to go nowhere. Companies trading at 8 times earnings with strong cash flows and growing businesses tend to get re-rated over time. The dividend provides the base return, the multiple expansion provides the kicker together. They can generate substantial wealth. This is why I love buying dividend stocks during panics. The downside is limited by the yield support. The upside is substantial if sentiment improves. The risk-reward is asymmetric in favor of the investor, and the regular income provides positive reinforcement that makes it easier to hold through continued volatility. I do not know exactly when these 3 stocks will be recognized by the market. It could be 6 months, it could be 2 years, it could be longer, but I am confident that the fundamental value is there, that the dividends will continue flowing, and that patient capital will be rewarded. The panic will end. It always does. Fear gives way to rationality, prices reconnect with fundamentals, and the investors who bought during the panic will look back and wonder why they ever hesitated. I have seen this cycle repeat throughout my career. The specific circumstances change, but the pattern is consistent. Panic creates opportunity. Opportunity rewards those who act. And the dividends collected along the way make the waiting tolerable. Right now, I am buying telecommunications at 8% yields. I am buying pharmaceuticals at 6% yields. I am buying tobacco at 9% yields. I am buying real businesses with real cash flows at prices that assume permanent disaster. When everyone else is panicking, I am putting capital to work in dividend stocks that will generate income for years to come. That is not what most people expect from me, but it is exactly what the opportunity demands. Let me go deeper on something that separates successful dividend investors from unsuccessful ones. It is the ability to distinguish between dividend traps and dividend opportunities. A dividend trap is a stock with a high yield that looks attractive, but where the dividend is about to be cut. A dividend opportunity is a stock with a high yield that looks scary, but where the dividend is actually secure. The difference between traps and opportunities often comes down to 3 factors: cash flow coverage, balance sheet strength, and management commitment. Cash flow coverage means the company generates enough free cash flow to pay the dividend with room to spare. I look for payout ratios below 70% of free cash flow. That leaves a cushion for unexpected challenges and funds for debt reduction or growth investments. All 3 stocks I am buying have comfortable coverage ratios. Balance sheet strength means the company can maintain the dividend even if business conditions deteriorate temporarily. A company with excessive debt and near-term maturities might be forced to cut the dividend to preserve liquidity. A company with modest debt and staggered maturities has the flexibility to maintain the dividend through temporary challenges. All 3 stocks I am buying have investment-grade credit ratings and manageable debt profiles. Management commitment means the leadership team views the dividend as sacrosanct. Some companies treat dividends as an afterthought that can be cut whenever convenient. Other companies treat dividends as a solemn obligation to shareholders that will be maintained through thick and thin. All 3 stocks I am buying have management teams with multi-decade track records of prioritizing the dividend. When you find a stock with high cash flow coverage, strong balance sheet, and committed management, trading at a yield that implies distress, you have found an opportunity, not a traplet. Let me tell you about a mistake I made early in my career that taught me this lesson the hard way. In the early 2000s, I saw a company with an incredibly high dividend yield. I think it was paying something like 12%. The company was in a cyclical industry that had been beaten down, and I assumed the yield would prove attractive as the cycle turned. What I missed was that the company had borrowed heavily during the good times, and the debt was coming due during the bad times. The cash flow that looked adequate on paper was actually committed to debt payments. When refinancing became impossible at reasonable rates, the company had to cut the dividend to preserve cash. The stock crashed further, and I took a substantial loss. That experience taught me to always stress test the dividend against the balance sheet. A high yield means nothing if the company cannot maintain it. Since then, I have focused intensely on financial flexibility when evaluating dividend stocks. All three of the positions I am currently building past that stress test with room to spare. I want to address the question of why dividend stocks specifically, rather than other value investments. Why not buy beaten-down growth stocks or cyclical businesses or distressed debt? The answer relates to my philosophy of getting paid to wait. When you buy a dividend stock, you receive income while waiting for the market to recognize the value. That income compounds over time and can represent a substantial portion of your total return. When you buy a non-dividend paying stock, you receive nothing while waiting. Your entire return depends on the stock price eventually appreciating. For a contrarian investor like myself, patience is essential. I am often early to ideas. I see value before the market sees it. Sometimes the market takes years to come around to my view. During those years, I need to maintain my conviction and avoid being shaken out of positions by continued price weakness. Dividend income makes that patience much easier. Every quarter, I receive confirmation that my thesis is intact. The company is generating cash and sharing it with me. That positive reinforcement helps me hold through volatility that might otherwise cause me to question my analysis. There is also a mathematical advantage to dividend reinvestment during periods of depressed prices. If I collect a 6% dividend and reinvest it at prices that are 50% below fair value, I am effectively buying shares at a discount. When prices eventually normalize, those reinvested dividends will have generated outsized returns. This is why I specifically seek out dividend stocks during panics. The combination of high yields and depressed prices creates a powerful compounding engine. You are collecting more dividends because yields are elevated, and those dividends are buying more shares because prices are depressed. The double benefit can dramatically accelerate wealth building for patient investors. Let me share some historical context that illustrates this point during the financial crisis of 2008 and 2009. Dividend stocks as a category were beaten down alongside everything else. The yield on the S&P 500 briefly exceeded 4%, which was extraordinarily high by historical standards. Investors who bought dividend stocks during that period and held them through the recovery generated returns that far exceeded the broad market. Not only did they benefit from the eventual price appreciation, but they collected elevated dividends the entire time. And those who reinvested the dividends at depressed prices saw their share counts grow rapidly. The same opportunity exists today in the specific stocks I have identified. Yields are at multi-year highs, prices are at multi-year lows. The ingredients for exceptional long-term returns are present. The only question is whether you have the courage to act. I also want to discuss how these dividend investments fit into my broader portfolio strategy. I am known for making concentrated bets on specific ideas. My short of the housing market in 2007 was a concentrated position that generated enormous returns. People sometimes assume I only make dramatic swing for the fences investments. But that is not the whole picture. Alongside the concentrated speculative positions, I always maintain a core of stable income generating investments. These dividend positions provide ballast for the portfolio. They generate predictable returns that compound over time. They reduce the overall volatility of my investment results. The dividend stocks I am buying today serve that purpose. They are not going to 10 times in value overnight, but they are going to generate steady income, grow their dividends over time, and likely appreciate substantially as valuations normalize. They are the foundation upon which I can take other risks. This balance between aggressive speculation and conservative income generation is something I have refined over decades. The speculative positions provide the opportunity for exceptional returns. The dividend positions provide the stability that allows me to maintain those speculative positions through volatility together. They create a portfolio that can generate strong returns without excessive risk. For investors who want to follow a similar approach, I would suggest thinking about your dividend allocation as the stable core of your portfolio. These are positions you can hold for years or decades. They generate income that can fund your living expenses or be reinvested for growth. They provide peace of mind during market turbulence. Around that stable core, you can layer additional positions based on your risk tolerance and analytical capabilities. But the core should be dividend stocks of the quality I have described. Strong cash flow, solid balance sheets, committed management, trading at attractive valuations. Let me close by returning to the psychological dimension of dividend investing during panics. I have emphasized the analytical framework, the specific stock selection, the portfolio construction, but ultimately the hardest part is not intellectual. It is emotional. When you see a stock down 60%, your brain screams danger. When you read headlines about an industry in decline, your instinct is to flee. When your neighbor tells you that only fools buy dividend stocks in this environment, you doubt yourself. Overcoming those emotional barriers is what separates successful investors from unsuccessful ones. The analytical skills can be learned. The emotional discipline must be practiced. Every time I buy a dividend stock during a panic, I am practicing that discipline. I am training my brain to interpret fear as opportunity. I am building the psychological muscles that allow me to act when others are paralyzed. And I am accumulating positions that will generate income and appreciation for years to come. The telecommunications company yielding 8%, the pharmaceutical company yielding 6%, the tobacco company yielding 9%, these are not abstract ideas. They are real businesses with real cash flows that I am buying with real money. When the panic ends, and it will end, I will own substantial positions in companies that the market currently despises. Those positions will have cost me far less than they would have cost during calmer times. And the dividends I collect between now and then will further reduce my effective cost basis. That is how wealth is built, not by following the crowd into popular investments at elevated prices, by having the courage to buy quality businesses when everyone else is selling, by collecting income while waiting for the market to come to its senses, by compounding patiently over years and decades. The opportunity is here. The dividend stocks are flashing buy signals that I have rarely seen this compelling. The question is whether you will act or whether you will let fear paralyze you while others profit from your inaction. I know what I am doing. I am buying.